Make the wealthy pay their fair share. It is a highly effective political message because it offers a seemingly painless solution to complex societal problems like healthcare, education, and housing. Its popularity relies on an economic concept called fiscal illusion. Fiscal illusion is a psychological blind spot where voters perceive government services as free because the costs are hidden or paid by a tiny minority of the population. When the vast majority of voters believe they are shielded from the cost of new programs, politicians face an overwhelming incentive to promise limitless expansions of the social safety net. They never have to ask the median voter to actually foot the bill. We can see the mathematical limits of this approach in New York. The state has the nation's most progressive income tax system and collects record-high revenues, yet it currently faces projected structural deficits of over $27 billion across the next 3 years. The slogan itself is not the problem. The flaw is that it breaks the basic order of operations in government finance by treating revenue extraction as the very first step of the process, rather than the final step. Skipping straight to taxation allows lawmakers to mask a severe spending crisis as a simple revenue shortage, a misdiagnosis that guarantees the structural gaps will only grow wider over time. At the federal level, the tax base is already highly concentrated. According to IRS data, the top 1% of earners already pays roughly 40% of all individual income taxes. State-level data reveals an even steeper incline. In New York, less than 1% of filers carry the immense burden of paying nearly 45% of the entire state's personal income tax liability. High-income wealth does not come from steady, predictable biweekly paychecks. It is generated by capital gains, bonuses, and business profits, all of which swing wildly alongside the stock market. This line chart tracks reported capital gains in New York State over recent years. Between 2021 and 2022, those capital gains plummeted by 48%, instantly evaporating billions in expected state revenue. This creates a volatility trap. Relying on this narrow base to fund permanent, fixed social programs is like paying rent with unpredictable casino winnings. When you build compounding safety nets on top of cyclical, volatile income, you engineer a system that will inevitably fail exactly when vulnerable populations need it most. If tax revenues from the wealthy drop during a market downturn, the obvious political response is to simply raise the tax rates on that top 1% even higher to cover the shortfall. But top earners, star scientists, and highly productive inventors are highly mobile. They adapt to new burdens by shifting the timing of their income, changing where they invest, or physically relocating to a new state. An economic study of top-bracket taxpayers in California showed that outward migration, combined with behavioral responses from those who stayed, erased more than 45% of the expected windfall from a major tax hike. The attempt to tax your way to a balanced ledger also triggers the tax spend hypothesis. This economic phenomenon occurs when raising taxes without strict balanced budget constraints causes a government's spending to expand automatically to absorb the newly available cash. Because the new money is immediately consumed by new program expansions, the underlying structural deficit remains completely untouched. Squeezing a mobile, volatile tax base indefinitely does not balance the ledger. It shrinks the economic pie and drives away the engines of innovation, while the root problem of uncontrolled spending continues to rot the foundation. To build a sustainable government, lawmakers have to adhere to a strict, mathematically sound order of operations. Step 1 is an absolute rule. Any credible fiscal plan must begin with structural spending reform, because you cannot tax your way out of a spending problem. In a place like New York, executing Step 1 means passing strict mandates that block the creation of any new discretionary spending, unless it has a dedicated, long-term funding source attached. It requires making difficult political choices, like putting the growth of Medicaid on a sustainable trajectory and overhauling education funding formulas to target actual, verified student need, rather than distributing money to satisfy political constituencies. Acknowledging this economic reality does not mean wealthy citizens shouldn't contribute to the public good. It means that determining their optimal tax rate is Step 4, a dial that can only be adjusted after the budget's structural integrity is secured. Ignoring Step 1 turns tax the rich from a policy goal into political theater, a distraction that eventually bankrupts the working-class citizens who rely on a stable safety net. A thriving society requires broad-based economic growth and a sustainable ledger. You cannot guarantee either by trying to balance the weight of an entire state on the shoulders of a fraction of a percent.